Hello, everyone. Thank you for tuning in. So, today we are going to talk about the fractal nature of charts, which is what we've been talking about, but we're going to talk about some patterns, ascending and descending triangles. Now, a lot of patterns, in my opinion, are kind of worthless, right? And I've been doing this for a long time. I've been a member of the Market Technicians Association for a long time. So there's a lot of things I don't really pay attention to when people say, oh, this is this pattern or this is that pattern. But one of the things I do pay attention to is ascending and descending triangles. Now, if you're viewing a chart through the right frame of mind or the right prism or whatever you want to call it, you're looking at investor psychology. And if you're not, you're never going to figure it out. You'll never figure out how to read charts if you just think about earnings and price to sales ratios and whatever's in the news. It's all about psychology, as we've seen in the prior two parts of this lesson. The reason why ascending and descending triangle patterns are reliable is, well, I mean, one reason is because the dynamics of the market that they show are pretty simple. An ascending triangle shows that there are aggressive buyers and complacent sellers. People take a position. As time goes by, the sellers kind of hang out. The seller's like, hey, we're at 50. And when it starts off, the buyers might be like, all right, we're at 40. And then a month goes by and the seller's like, you know what? We don't really care. We're still at 50. We're not willing to reduce our price. The buyers might say, we're willing to pay 42. Another month goes by. The sellers might say, you want to come and get it. We're not going to be aggressive. Buyers are willing to pay 43, so forth and so on. A descending triangle is the opposite. This is where the buyers are chill. The buyer's like, all right, I'm at 50. You want to come and sell to me, fine. If not, I'm not going to chase it. The sellers start off at 60, then they go to 69, then they go to 68. They're trying to sell, they're getting aggressive. They see other sellers trying to undercut them, and they say, I better go to 66 or 65. But meanwhile, the buyers are just hanging out. They're not moving. They're just like, whatever. So, ascending triangle shows aggressive buyers and complacent sellers. A descending triangle shows aggressive sellers and complacent buyers. Now, doesn't matter what market you're talking about, stocks, options, commodities, cryptos, commodities, housing, basic economics 101. If you have aggressive sellers and buyers that are chill and that are just like, yeah, whatever, I'm willing to step back and let you come to me, so now it's something that can move the price lower. And the opposite is true in the ascending triangle. So let's just go look through a bunch of examples. And I just want to kind of put these all out there and just go through them without too much of a description, because the idea is not to go out there and find the perfect picture, perfect ascending triangle or descending triangle and say, hey, Mark, I found a perfect this or that or the other thing, whatever. The idea is to understand what this is showing us. So here we have an ascending triangle. The sellers have hung out. They've been there. They've been there. They're like, yeah, whatever, man. You want to come to me? I mean, think about it. You can think about it in any context. Pretend you're at a concert and you're going to a scalper, and there's a lot more people that want to buy tickets than want to sell tickets. Well, the scalper they're not going to break their price in trader terms. They're going to just hang out because they know eventually they're going to sell it. Well, not that they know, but anyway, but the buyers are getting more anxious. They're like, oh, man. So they enter the market at higher prices each time we get a little bit of a reversion. So you have aggressive buyers, meaning they're willing to pay higher prices, complacent sellers, meaning they're willing to just chill and whatever. When you get people that are really eager to buy and people that don't really care about selling or like whatever, sets the stage up for a move higher. You can even see here, this is the opposite, the descending triangle, which we're going to cover. The buyers are complacent here. The sellers are getting more aggressive. The buyers are like, hey, you want to come to me? Fine. If not, whatever. The sellers are like, oh, man, I really want to get rid of this. I better reduce the price I'm willing to sell at It's like the sellers just kind of get freaked out and they undercut each other. And these are the dynamics that lead to a big move lower. And sure enough, that happened here. And then the ascending triangle illustrates the dynamics that can bring us to a move higher. Remember, if you're going to look at a chart, you got to look at it through the prism of supply and demand and human emotions. If you don't do that, you're never going to figure it out. A descending triangle illustrates buyers who are chill, sellers who are aggressive. An ascending triangle illustrates sellers who are chill and buyers who are aggressive. All right, let's go take a look at another one. So this is a good illustration of the fractal nature of charting. What we just saw was complacent buyers, complacent sellers, buyers becoming more aggressive, sellers becoming more aggressive over an extended time period, a few months. Here we have a chart that just shows a few hours during the day. And we see the same dynamics. This is the same pattern. The ascending triangle. Sellers are patient. Buyers get aggressive. When you look at a chart, you're looking at an illustration of the psychology of the people that are doing the trading. This is the psychology of people that are short-term traders. This is like day traders. Day traders get aggressive as times go by. Some day traders stay passive. The point is you can look at any chart from a different time frame, whether it's a day, a year, 3 months, 10 years, 5 years, whatever. You're going to see the same patterns. And this is what I call the fractal nature of charts. And the reason why we see these same patterns is because they are an illustration of the psychology of the people that are trading. And if you look at this here, this is the psychology of people that are short-term traders. If you look at a chart that's 5 years, which we will in a minute or two, that's the psychology of investors or traders that have a long-term strategy. I'll tell you, I've been doing this for a long time, and this stuff still fascinates me. And I think it will for the rest of my life. Here we have the ascending triangle, right? So this goes from resistance stays intact from February through July. Sellers, they're just like, yeah, whatever. You want to come to me, I'll sell to you. If not, you snooze, you lose. The sellers, maybe they know that the market's coming their way. The buyers are getting aggressive. These are what we call lower highs, right? The low forms at a higher price than the previous low. Markets go in peaks and valleys, and when the valley forms at a higher level than the prior valley, we call that a lower high. This is important because it shows us that as time is passing, the buyers are willing to pay higher prices or becoming more aggressive. This is part of what the ascending triangle pattern shows. So here is, I would say this is one's about 8 months. Here we have another chart of just the day, U.S. Steel. Doesn't matter what security it is. It could be U.S. Steel, it could be NVIDIA, it could be a commodity, it could be rice, corn, some bond, some ETF. Doesn't matter because everyone who trades these things is a human. Well, whatever it may be, for now, at least for now, until AI takes over. Woo! But anyway, so whether you're a trader who's a short-term trader who trades stocks, a long-term trader who trades commodities, a swing trader who trades bonds, people feel the same emotion. So here's a real short-term chart. This here just shows about 2 hours or 3 hours. Sellers are hanging out here. The buyers are coming more aggressive. Sets the stage for a move higher, just like we saw in the longer term. Okay, here's an ascending triangle. See the higher lows? Sellers are chilling. Sets the stage up for a move higher. That's a 4-month chart. Descending triangle. The buyers chill. The sellers get more aggressive. Sets the stage for a move lower like it did here. This is lower highs. The peaks form at a lower level than the prior peak. So higher lows when the valleys form at higher price levels is bullish. Lower highs when the peaks form at lower levels, that's bearish. Lower highs tell you the sellers are getting more aggressive. Higher lows tell you the buyers are getting more aggressive. Here we got a chart that's about a month. Very clear descending triangle. Excuse me. And here we, again, here's a chart that's just a few hours. These patterns are reliable. They're not infallible. I would say they work out maybe 70% of the time, 2/3 of the time. They're not infallible, but it's not about identifying the pattern, everyone. It's not. It's about saying, wow, the buyers are hanging, the sellers are getting more aggressive. It doesn't matter what you call it. You can call it anything. You can call it a descending triangle. You can call it a, I don't know, a Joey Shuju Babadoo or whatever from The Simpsons. Joey Jojo Shabadoo pattern. You call it whatever you want. It doesn't matter. What's important is what it shows. Buyers are chill, sellers are getting more aggressive. And from our previous lessons, you can see here what was support converted into resistance. This is also psychology. People that bought here experience buyer's remorse when it goes lower. And when it gets back up to their price and they get out at break even, they sell. So these big group of remorseful buyers placing sellers could form resistance. Descending triangle here. And these are real companies. I mean, obviously they're real. Procter & Gamble, same thing. Buyers or whatever. Sellers like, I got to get the hell out. Buyers are like, whatever. Sellers are like, I got to get the hell out. And then you can see we reverse and what was support becomes resistance. This is not as clearly illustrated, but it's pretty clear what's going on. I don't mean it's not clearly illustrated. It's just not as perfect as this. Look at this. I mean, this is a textbook. It should be in a textbook, and maybe one day I'll write one. But I don't really need to. You guys could just get all these lessons, and eventually, I guess we'll throw it together in a textbook. But there's definitely going to be enough there for that. So if you're watching this, thank you, because you're giving us a chance. All right, so here we have a descending triangle. Support stays intact. Buyers like, hey, you want to come to me? Fine. Sellers like, get me the hell out. Sets the stage for the move lower. This is a chart that is about 9 months long. Here we have kind of a long-term chart. This shows a couple of years. This is our this Central and European Fund, an ETF. This support lasted from April to September. Descending triangle leads to a move lower. Then the next year, April to July, ascending triangle gives us gives us a little hint that, gee, maybe the next move is up. Sure enough, it was. And here it was too. This is what I mean by the fractal nature. In a chart like that, we're probably looking at the psychology. Well, actually, I know we're looking at the psychology of the long-term buy and hold investor. Here we're looking at the psychology of swing traders. Swing traders are people who trade they get into position for a couple days, maybe a couple months. Support, lower highs, descending triangle. Resistance, higher lows, ascending triangle. Descending triangles illustrate bearish dynamics, which means there's a really good chance the market's going to go down. Ascending triangles illustrate bullish dynamics, which means there's a really good chance the market is going to go up. Here's a descending triangle pattern in General Motors. Support for over a year. This descending pattern took place over, actually, well, that's a year. That's about 6 months. But regardless, forget that. You just got to notice, oh, the sellers are getting more aggressive. Go back to my example of you're going to a concert and you want to buy tickets from a scalper. Well, if the concert didn't sell out and the scalper is afraid they're going to take a bath or lose a lot of money, they may be willing to reduce their price that they're selling at. They know they're going to lose money, but they're going to lose less. If the place is sold out and everyone wants tickets, the scalpers are going to raise the price that they're willing to sell at. So here is like people are freaking out that there's not enough buyers around. So they just get more and more and more aggressive. Here's the buyers like, yeah, whatever. Okay, we know that there's not a lot of tickets out there. Eventually the scalper who just offered us these tickets at $100 is going to come back and be like, I'll sell you these tickets at 50. So just supply and demand, everybody. Here's a really long-term descending triangle pattern. Notice the lower highs that formed over the course of over a year. And then we have some of our principles from before. What was resistance becomes support. What was support becomes resistance. People that bought here, people that sold here go to buy back here because they regret selling when the price goes higher, and they tell themselves, if this gets back to my price, I will buy it back. Over here, you get support turns into resistance because you have people that bought here. When the price goes down, they're like, oh, if I can get out of break even, I'm going to. So when it gets back to their price, they go to sell. So seller's remorse turns resistance into support. Buyer's remorse can turn support into resistance. Aggressive sellers, who are people who become aggressive over time, in other words, they're more anxious to get out, are willing to reduce the prices they're willing to sell at. So the peaks form at lower prices. That's our descending triangle pattern. Here's another one. Just keep looking at these things, kind of get them in your mind, and forget, you're not here to be like, oh, this is this pattern or this is that pattern. You're here to understand how to interpret market dynamics. That's what I want to teach you. And these are really good illustrations. Of course, it's not perfect, but definitely helps you along the way. Sellers hang out, buyers get more aggressive. Now, this is not a perfect pattern, but it illustrates something very important. Higher lows. Resistance, resistance, resistance becomes support. So even though it's not a perfect pattern, doesn't matter. Doesn't need to be perfect. It still shows you what it wants to show you. The market is talking to you. The market is saying buyers are getting more aggressive. The best traders let the market tell them what to do. All right, everybody. Thank you so much for tuning in, and I hope to see you soon.